Now let's talk more stocks. Go live now to Singapore and bring in our guest, Mark Matthews, Head of Research at Asia, Bank Julius Baer, joining us. And Mark, a bit of a trigger reaction here from investors in reaction, I guess, to the poor Spanish bond auction and also to the comments coming from the Spanish Prime Minister.
Yes, I think that's definitely a material event. The fact that the Spanish auctions, the yields achieved are no longer less than they were the previous few weeks or the previous few months. Are now rising again. And Susan, the other important thing I think that caused the markets to go off down so much last night was Draghi's comments that it's up to governments now to reform in order to stimulate growth, and it's not the ECB's job to stimulate growth, and that if inflation is a problem, he will react to it. So it's a very different language that we've become accustomed to from him since he took office last year.
Mark, it's Rishaad also joining Susan in Hong Kong. Did we just get a bit too complacent? Did people get too complacent? And, you know, this has really come home to roost now again.
Rish, I don't know is the honest answer. I mean, I find these financial contagions are, I'm sorry to be morbid, but it's almost like cancer. I mean, you can beat it and you just don't know if it's going to come back, when it's going to come back, but you have to live the rest of your life as well as you can. So I'm not going to stay up at night worrying about Europe. I feel like it is more under control than it was last year, and it's no longer achieving the front pages the way it was. But I don't want to say, you know, I absolutely am sure it's never going to come back and take us down. I feel markets were overextended technically anyway, and then what the Fed said earlier this week was another catalyst for us to come down. So I don't think Europe's the only reason why we're correcting.
The thing is, we of course get that non-farm payrolls report, and that should perhaps indicate that the US recovery is on a firmer footing. I mean, this is the quarter when we find out whether it's for real, but what are you looking at? And it is the bright spot in the global economy, it would seem, right now, along with China.
Well, are you sure China's a bright spot? I don't know about that.
Well, it's brighter than it was.
The US is certainly. Yeah, I mean, I'm a believer in the U.S. recovery, and I'm bullish on the U.S., but I also don't know if these payrolls are going to be great tomorrow. As a matter of fact, Trim Tabs, which looks at the daily remittances to the Treasury Department of all employees in the U.S., reckons that it's going to be quite a bit below 200,000, and I think consensus, according to Bloomberg, is about 206,000. But even if the payrolls miss, I still feel like it's a bull market. But the number of indicators to me suggest that we need to reset, and we're in the process of resetting. Maybe, I don't know, 5 to 10% downside, and then I think we can go higher.
Okay, we can go higher. So in the meantime, what do? You buy in on the dips? Is that what you're advising?
Well, not today, but you know, whenever you feel it's gotten cheap enough, yeah, I think actually, you know, these few months, if you just look back at the seasonality, are never really great months. So I wouldn't be expecting a rip-roaring bull market over the next month or two, and given these huge gains, it could be lower. There's no huge urgency to buy. But I also don't think you're going to lose a lot of money either, because I think there's a very powerful undercurrent in the economy in the U.S. So I don't think there's an urgency to buy today.
So what we're seeing right now is a general view, really coming to the fore right now, that it is going to be hard for these markets in Asia to push any higher in the near term. Would you agree?
Yes, in the near term, but I mean, they've been incredibly resilient. So I think I myself am guilty of having called for corrections that never happened several times this year. You just never know. Maybe those payrolls will hit the skin off the ball tomorrow night, and the markets will be flying. But if you look at the advancers and decliners ratio in the NYSE, it's actually been falling for the last several weeks, and that cannot be sustained forever without the S&P correcting as well.
Okay, so what do we get here? I mean, what about China? You know, an equity market which has done very well this year. We've also got, of course, foreign investors being able to invest more money here with that capital base being widened, or increased. So how does that benefit equities there in Shanghai and Shenzhen?
Well, the onshore markets have not been very good, but you're right, the H-share market's been good. I think that's just because it's sort of a beta play on the global markets. And foreign fund flows, I also don't think are material enough to really move the Shanghai Composite Index. So my view on China, I actually remember the last time I was on the show, it was the day when Jiabao announced the new target for 7% GDP growth. And at the time I thought, well, big deal. But it turns out people were really shocked at that. And I think there's still a shock, at this idea that China's never going to grow at 10% again, which I actually feel pretty confident in saying. But when people sort of calm down and realize that 7 or 7.5 is still an extremely good number, in fact, much higher than everywhere else in Asia practically, and the market's now cheaper than most countries in Asia, then it'll go up, and but I don't think we're there yet. I think people are still shocked.
What do you advise people to do right now, generally with their money there at Julius Baer?
Well, I've been bullish on the U.S. and I continue to be. I don't know what kind of time period you're talking about, but if I was to say on a 12-month view, telling people to own U.S. stocks and own Asian high-yield bonds, and been telling people that it's going to be difficult for emerging markets to outperform in the current environment, and in fact they've been underperforming for the last 2 years. So I think that continues. But I think there's always good stocks. There's always good opportunities in emerging markets, and I look at HSBC, for example, which I guess is not really an emerging market stock, but has a lot of emerging markets in it, and I think it's very rare you get the opportunity to buy HSBC on less than 1 times book for a 4.7% dividend yield. Similarly, I look at Thai Reinsurance in Bangkok, which has lost half its value and just been recapitalized, and I think it's a good buy.
Wow.
Financials in general I like. Also like IT.
Mark, thank you so much for your time. Mark Matthews there from Bank Julius Baer.